The weekly newsletter for the 2nd of December 2008. Gearing. Today I'd just like to talk about gearing. Now, a lot of people have been hurt by gearing up margin loans and margin calls over the last 12 months, and certainly gearing is not the first thing on people's mind. In fact, I think gearing down is probably more important. But what is gearing, and how do we actually truly understand what gearing is? Look, I liken gearing to driving a car. The higher the gear you use, the faster you go while the motor is working at the same rate. Now, the same is true for your investments. The more you borrow, the faster you get to where you want to be, and the more money you'll make. But there is, like a speeding car, some level of risk involved. Now, back in the 1972 oil shock and the 1997 Asian crisis, the 2000 tech wreck, 2001 9/11, and now the 2008 credit crisis, all investors have become acutely aware of the risks which are faced when you are gearing or borrowing to invest. Now, this doesn't mean you should stop gearing. It certainly means you just need to take an educated and controlled approach to gearing. In the credit crisis we've seen in 2008, what we saw 5 years prior to this is a high level of gearing. We saw new products such as CFDs, which are highly leveraged products, come into the marketplace. We saw a lot of uneducated investors using discount brokers gearing up in a strong 5-year bull market, making a lot of money, but not realizing the potential risks of being over gearing. And such, we have seen people get badly burnt. But right now, when we look at fundamentals of the market, now really is the best time to start gearing. And there's two main reasons for this. First, the market is at an all-time low and is certainly cheap around these levels. Second, interest rates are coming off, which means that you can get a better return now. You don't need such a high return from your shares to cover the cost of the borrowing. A good example is your banks. Most of your banks are now paying between 8 and 10% frank returns, and your gearing level or your installment warrant level is trading around the 7 or 8%. Plus you've got capital growth on top of that. So it is a good time to be gearing. However, I would think most people listening to this newsletter would be cringing in their shoes, thinking that I'm suggesting you gear. What I am suggesting is we start looking at Sensible's approach to gearing and some new products which have come on the market over the last 5 or 6 years. Now, the primary one I want to talk about today is a self-funding installment warrant. Now, what is that? It's a warrant. It's like a lay-by. You pay 50% now and you pay the other 50% in 10 years' time. Now, over that period of time, you will be charged interest by the supplier of the warrant, but your dividends will go towards paying down any outstanding loan. In short, if you were to go out and buy one of the banks now through a self-funding installment warrants, in 10 years' time, it would be paid out, so you'd own the stock. Along the way, all the dividends you receive would go to pay back your loan, but you'd still get benefit of the franking credit to offset any tax that you have to pay. The best thing about self-funding installment warrants is, one, they can be used in your super fund, so you can gear up in your super fund, and that's probably not attractive for people in their probably mid to late 50s, or certainly if you're 60 and retired, you don't want to be gearing. But if you're young, if you're in your 20s, your 30s, it's certainly a very big advantage to be able to gear through your super fund through self-funding installment warrants and get a little boost along the way. Keep in mind, if you are 30 years old, you have 30 years to go before retirement, so the gearing benefits will really come into their own around that point in time. The other major benefit of gearing, of self-funded installment warrants, is that you limit your downside risk and you don't have margin calls. Now, what does that mean? Now, limiting your downside risk means simply, if you were to borrow $50,000, buy $50,000 with self-funded installment warrants in BHP, you'd have the same exposure as if you owned $100,000 in BHP but borrowed the funds through a margin loan. The big difference is, if BHP was wiped out and went to zero, you would lose $50,000 on a self-funding installment warrant. However, if you borrowed through a margin loan and you owed the whole 100, although your shares are now worth nothing, you still owe $100,000 a margin lender and they will still collect it. So self-funded installment warrants are a great way to limit your exposure to the downside risk of the market, while at the same time benefiting from a gearing strategy and still receiving the franking credits. Now, in this week's newsletter, I have linked a few sites into there which are linked back to the ASX. Now, the ASX, these two sites are for educational purposes only. Please do not try to do this sort of thing by yourself. You do need to be specialised in the area to do self-funding installment warrants, and we will spend some time with any of our clients who are very interested in this sort of product. Now, these two sites, the first will talk to you about warrants. Don't try to take it all in. There's a lot to learn. The second will talk to you more about self-funded installment warrants. Have a listen to these two sites, and if this is the sort of thing that you might be interested in, or if you think someone in your family, children, grandchildren might be interested in, give them our number 47714577, or direct them to our website at growyourwealth.com.au, and we'll start educating them in the self-funding installment warrants. For more information, go to our website at growyourwealth.com.au. Thank you.